All right, today we're tackling a question that trips up a lot of investors, even the pros. ETFs versus index funds. What is the actual difference? Let's get right into it.
On the surface, they look pretty similar. They both let you track a market index, and they're both known for being low-cost, diversified ways to invest. But the devil, as they say, is in the details, and those details can really make a big difference in your portfolio. So let's break it all down.
To really get a handle on these funds, we have to start with the big, powerful idea that they both share. Okay, so what is passive management? Well, instead of trying to be a hero and pick the next big stock, the whole idea is to just own the market. You're trying to grow with it. It's all based on the theory that, trying to consistently beat the market over the long run is, well, it's nearly impossible.
And wow, this chart right here shows you just how revolutionary that idea has been. Look at that red line go. In the decade after the 2008 financial crisis, investors poured literally trillions of dollars into passive funds, completely reshaping the entire financial world.
So they share this big picture philosophy, but when you look under the hood, their mechanics are surprisingly different. It's time to get into the nitty-gritty.
Okay, so here's a quick side-by-side look at the key differences we're going to unpack. You can already see some big ones, right? Like how they trade and what it costs to just get in the door. What's so interesting here is how this table really lays out the core trade-offs you have to think about: flexibility, cost, and just how easy it is to get started.
So the biggest difference, for sure, is flexibility. ETFs trade just like a stock. You can buy and sell them anytime the market is open, and their prices are moving in real time. Index funds are different. They're priced just once a day after the market closes, based on something called their net asset value, or NAV. You can think of NAV as the fund's total value divided by all its shares. It's just one single price for the entire day. See, they're really designed for long-term, set-it-and-forget-it investing, not for reacting to every little market swing.
All right, let's talk about one of the most important things for any investor: fees. A really detailed academic study gave us some hard numbers on how these two stack up, and trust me, these small differences can add up to a lot of money over time.
So, the study found that the average annual fee, the expense ratio, for the ETFs in their sample was just 15 basis points. Now, just so you know, 1 basis point is 0.01%. So we're talking about 0.15%. That is an incredibly low cost to have your money managed.
Now compare that to the index funds. They had an average fee of 27 basis points. That's 0.27%, nearly double the cost of the ETFs. So here's the key point. While both of these are definitely low-cost options, ETFs often have a clear edge when it comes to that annual management fee.
And it's not just the management fees either. ETFs are generally built to be more tax efficient. Okay, so here's why that's a big deal. With a traditional index fund, when a bunch of investors sell their shares, the fund manager might have to sell some stocks to get the cash to pay them. Well, that sale can create a taxable capital gain for every single person who owns that fund. But ETFs have this really clever workaround. They use a process called in-kind redemption, where they basically just swap ETF shares for the actual stocks themselves, without ever selling anything. This whole process helps minimize those taxable events, which is a huge advantage if you're investing in a regular brokerage account.
Okay, so we've looked at the differences in trading, cost, and even taxes. But now we get to the most important question of all. What does all this mean for your money?
Your choice really just boils down to your own personal investing style. Index funds are all about simplicity and discipline. They're absolutely fantastic for automating your savings and just staying the course without getting distracted. ETFs, on the other hand, they're for the more hands-on investor who wants that trading flexibility, potentially lower costs, and access to a wider world of assets.
So let's wrap this up. We're going to zoom out from all the nitty-gritty mechanics and just look at the bigger picture for a second.
At the end of the day, both of these are just incredibly powerful, low-cost tools for building long-term wealth. Think of it like this. They'll both get you to the same destination. They just take slightly different roads to get there.
And ultimately, the financial planner David Tenerelli put it perfectly here. The goal with either one of these is to take part in the growth of the entire economy, not just bet on a few companies. You're not just buying a fund. You're buying a piece of the whole global economic pie.
So the main thing to remember is that you have a choice, and it's all about picking the right tool for you and the future you want to build. Thanks for joining us for this explainer.